So let's go ahead and dive straight right into chapter 2. What is accounting? Okay. Well, it's pretty straightforward. We talked about briefly what the definition of accounting was yesterday. So it is basically the systematic process of recording, analyzing, summarizing, and interpreting data, especially for all business transactions and events. So when we understand a transaction, we need to understand how it affects the business and what that transaction is in the first place. So, and then of course, we're going to take that transaction, kind of analyze it, and place it into categories. Okay. So again, a little brief little reintro is that we are focused on primarily what we're that we are doing financial accounting. Okay, there will be nothing with tax here, nothing with managerial or costing, or nothing with forensics. Okay, but that doesn't mean that you're limited to those options. Again, this class is the fundamentals, and it is the backbone of everything that you do. So with this concept that we learned today, and throughout this entire 15 weeks, it is going to help you understand how to do tax. It's going to help you understand how to do managerial, and especially it's going to help you to understand forensics. So again, in this kind of things, as we talked about the different areas of accounting, everything starts off with the basics of fundamentals / financial accounting. Understand how the business runs in the first place. So, with that being said, for those who are beginners to accounting, it is literally like learning a new language. Okay? You will start picking up terminology such as to receive is going to be called a receivable, to pay is going to be an expense, to owe is a payable or a liability. If you own property, it's an asset, right? If it's an obligation, it's also a liability. So there's going to be a lot of terminology that you will be learning in this class that, you know, it's you'll end up picking it up, and you'll realize that when we read a scenario or read a transaction, that is how you interpret it, and that is how you are able to strictly categorize it right then and there. If you buy something, that's you spending your cash, right? You're buying something, you're spending, you're paying for something. So yes, so it is learning, technically it is learning a brand new language. But it is using, of course, the English language to kind of ease your way and understand how the transaction works using those kind of terminology. Okay, it's nothing like big, like brand new words or anything like that. It's just common words that we use. Okay. So accounts. There are a total of 5 accounts, no more, no less. Okay, these accounts are pretty much going to kind of signify or kind of explain certain things that you should be doing or should have. So again, I talked about what assets are. Assets are everything that you own, okay? And your liabilities is everything that you owe. Your equity is going to reflect the value of your company, and revenues or / income is anything that you generate, okay? And then of course expenses are any costs that it takes for you to be able to complete or do operations, okay? So there are a total of 5 account types. So these are the total 5 types that you're going to utilize your transaction and categorize them, sort them out in these specific 5 things, okay? But I do want to let you know that there are also a few things that you need to know about these specific types of accounts. Your assets, liabilities, and equities are going to be your permanent accounts. And what that means is they never close at the end of the period. Okay? Now, what does that even mean? For example, when we close our books, which is going to be something that we learn towards the end of class, it's basically when we wrap up our company, we need to have some form of measurement that we can utilize to compare our progress or profitabilities. Okay, so what happens is at the end of every given period, which I will talk about, whether it is daily, weekly, monthly, or quarterly, we tend to close out our income and our expenses to reflect some kind of way to understand the transaction. Can you excuse me for 1 second? I need to answer a phone call. All right, can everyone still hear me and see my screen?
Yes.
Okay, so back to this point right here. So again, we close out our revenues and our income. That's the same thing. Revenues and our expenses at the end of a given period, because that is actually a form of measurement that we can use to understand profitability. When we looked at our income statement, all we cared about was looking at our sales and our total amount of expenses that it takes to run a business. And that's true because you can never expect that your revenues are going to reflect the same every year. Same thing with your expenses. The only thing that you'll have maybe some fixed expenses are your rent, but you may have things that occur such as advertising this month, or you dabble down on buying equipment for your stuff, and you placed it on an expense instead of place it in somewhere else. So every month, week, or daily, however you prefer your given period to be. Usually, typically, your revenues and your expenses, they fluctuate. They're not always consistent. So that's the best way we can measure profitability. Okay, and also, with that it being said, your assets, liabilities, and your equity they never close out because, for example, when we talk about what an asset is, you're going to learn that your checking account is an asset. If you close your banking account, that means you're done doing business. You can't really technically do business anymore because, and we'll talk about this in chapter 4, which is tomorrow, why it's necessary to have a separate bank account. So if you close your bank account, that means you're closing up your business and you no longer have it. So that's why it's very important that you understand the difference between permanent accounts and temporary accounts. Your assets, liabilities, and equity need to be open and need to stay open while your revenues and your expenses actually close out. Okay. With that being said, now I'm going to introduce every single section, every single account type. But before I do that, I need to also mention how you actually organize this information. Okay. So before diving into what an asset is and what a liability is, we need to understand how to create an account or what an account does. So for the first one I want to show you is that for example, every type of account or every account type, there's going to be main accounts. Main accounts are going to be kind of like the umbrella organization or the broader category where you can sort your data. Okay, we can recognize, when we recognize a transaction, we can recognize that it's an asset or a liability. We need to further explain or further divide the assets into even more specific details. So this is where we come into creating actual main accounts, and then we have two other ones called sub accounts and contra accounts. Now, a sub account too is kind of like if you're looking at a table of contents, right? You have the main chapter, and underneath it you have a section for each type of topic. This is very similar to that concept. The main account is going to be your broad organization, your broad term, or your broad folder, you could say. And your sub account is going to be the same thing, except it's going to be in more detail. So you're going to break it down even further. So for example, when we have inventory, right? Inventory is anything that we sell to our customers. Well, to even break it down even further is, well, what is considered inventory? What is the specific item you sell? And the sub account would be coffee mugs. Okay. Now, there's a lot of ways that you can indicate this. And for this example here, my main accounts are in caps, okay, and my sub accounts are in regular letters, okay. Now, to understand the difference between a main account, a sub account, and a contra account, so the main account has a specific flow of transaction, and we'll talk about this when we hit the normal balance. When there's a normal flow, meaning, let's say my cash account, normally the flow of the transaction is usually increased by a debit. If it's usually increased by a debit, your sub account is going to flow in the same direction. So if my inventory is increased by a debit, so will my sub account will be also increased by a debit. Okay? And what makes it a difference is when you go move into what a contra account is. Contra meaning opposite or counter. So contra account is another basically breakdown of either a main account or a sub account, but it flows in the opposite direction. So for example, if my accounts receivable, which is money that people owe to me, if I'm increasing it with a debit, then my contra account, which is the allowance for doubtful accounts, meaning my customers decides to tell me that they can no longer pay what they owe me, then I have to create a contra account that decreases my main account and it goes in the opposite direction. So therefore, it's a credit balance and it decreases my main account. Okay? So that is pretty much the difference between the types of accounts that we will learn throughout this course. And I want you guys to know that when we go through each chapter, I will discuss what these accounts do and what they really are. So we'll be learning a lot of main accounts, sub accounts, maybe not so much, but again, the main account is the content, the title, the chapter title, while the sub account is the more breaking down the chapter into more detail. And the contra account will be the opposite flowing one. All right, so that's just a brief little introduction there. Another concept that you need to know is understanding that left is debit and right is credit. When we go into our journal, you'll completely understand what it means that your debit's on the left side and your credits are on the right side. It's just the way that the table is created and how we calculate our total amounts of debits and credits. Now, when we move into understanding how to journalize, our rule is that our debits needs to match our credits. But another way to truly understand this is never refer your debits and credits as increase or decrease. All right, and I'll talk about this in the normal balance, because when we go into our normal balance, you need to understand that a debit can increase an asset, but it can also decrease a liability. Okay, so that is exactly why you cannot use debits and credits as increase or decrease. Okay. But there are some certain scenarios where I will be asking you, if this is an asset, okay, and I bought something, how do I interpret this? Since I spend the money, I'm going to be decreasing my account with a credit, okay? And I'm going to be increasing my purchases with a debit, okay? So right now, it may not make any sense, but it will make sense when we start diving in and we look at the accounting model. Okay. So again, just a rule of thumb: understand left means debit, credit means right, vice versa, and don't refer them as increase and decrease. Okay. And of course, we need to also ingrain this in you guys' brains, is that you need to know that this accounting equation must hold true wherever you are in any given day or period during your transactions. Your assets must always, always, always equal the total liabilities and your total equity. So again, I talked briefly about this. Your assets is everything that you own in the company. So your furniture, your checking account, your patents, everything, okay? And your liabilities are anything that you owe to other people or owe in general, such as a loan that you took out. And of course, you need to also include the total value of your company, okay? So again, no matter where you are, this equation must hold true, okay? So now we're going to actually talk about each and individual accounts as is, okay? So first one's first is your assets. So again, assets is everything that you own. So how do we categorize that even further? So, and we'll talk about this when we move into our chart of accounts, which is chapter 3. But understanding how to break it down even further when we have a specific type of account. So, again, we categorize it based on how easily it could be converted into cash. All right. So our current assets is going to be things that are again quickly converted to cash, but things that you can sell right away, or if it's already in its liquid form, such as cash, usually that will be at the very, very top. So in this example here, my current assets could be my cash because it's already in cash. It's already in its liquid form. Other things could be inventory, right? Even though we own the item, we can quickly turn it over and sell it the next day. So that's going to be considered a current asset, okay? Now, fixed assets are going to be categorized based on whether it is a property, plant, or equipment. Okay, so fixed asset could also be known as PP&E, property, plant, and equipment. So anything that's property, so land is going to be your property. Plant is going to be your building, so everything that's inside your building, so your furniture, your lamps, your countertops, okay, your desks, okay, and equipment are any machinery that helps you produce your product or helps you to run your business, okay? So in this sense, equipment can be anything like machinery. It could be a printer, anything that's typically considered something that helps you do business, okay? And a little key factor, and we'll talk about this when we dive into into the depreciation chapter, is that they actually have a life of more than 1 year. Now, let's think about this. Obviously, land has a life. It can exist. It lives for a long time. Same thing with the building. But what happens is a building, the more you keep using it, the wear and tear, if you don't paint your building often, it starts to get used and it loses value. Same thing with equipment, right? You place it into service, you're making that printer pump out a lot of paper, then you can know that with time, machinery does get outdated, it does get old, electrical wires will get loose. So you have to understand that they have a life of its own, okay? And we'll understand that more in depth when we dive into depreciation. But fixed assets, think about it. How long does it take to buy a building? It depends, right? It depends on your realtor, right? It depends on how quickly you sell your building. But think about the process it takes to just convert it into cash. You have to make sure that your building is okay. You have to go get it. I forgot what the term is. To check to see the value of your building is. Then you gotta put it appraisal. Yes, appraisal. You have to get it appraised. Then the second thing is you gotta now put it up on the market. Get a realtor. Have that person try to advertise and sell your building. Then after that, you have to go into that 6-month period where when you agree on the paperwork and making sure that the person's credit score is actually able to buy this building. It can take a long time to buy a building. So the notion here is it quickly convertible into cash? Well, it will depend on what it is. And the answer is obviously going to be no, it's not easy to convert into cash. So that's the example I would give there. Same thing with equipment. If you bought something and used it, do you think you can get money out of it quickly? No, because you gotta have to go do your research, figure it out, go on a public platform, post that you're trying to sell this item. Your customers need to check it out, XYZ. So that's the notion here, that when you are trying to convert your fixed assets into cash, it's not an easy and quick thing. So that's why it's going to be categorized under fixed assets. All right. And the second and last thing that is another category of assets is going to be other assets. Now, under other assets, it's pretty straightforward. This is typically going to be where your intangible assets are going to be. So an intangible asset is something that you physically can't touch. You can't see it either. All right, so those things are going to be things like patents, deposits, prepaid insurance or prepaid things, okay? Licenses are going to be considered intangible, right? You're going to be getting a piece of paper for most of these intangible assets. But the piece of paper isn't the physical asset itself. It doesn't represent what the item is that you purchased. For example, if I bought a patent, a piece of paper is not going to show. It's not going to prove. It's going to prove that you have a protection over your item, but can you see the physical protection over it? Do you see that plastic seal over it? Do you actually see the bubble around it? No, you cannot physically touch what a copyright is. So, and then typically those kind of things, you usually can't get your money back for it. You can sell your patent, yes you can, but you have to go through legal team for that. And another example I used is if you do prepaid rent. Now, prepaid rent to any landlord, tell me, How easy is it to get your money back once you've made your deposit? Yes, it's also not very easy, especially if it's something that you're um, trying to get back due to some situation. You may need to file a lawsuit, and filing a lawsuit can take anywhere from 6 months to a year just to get the money back from your landlord. So again, they have contracts that are legally binding. So yes, so it's another way of saying it's going to take a long time to get your money back or convert it into cash. So that is exactly how assets are categorized, and that's how you interpret each and every single one. Number one, your current assets are anything that you can liquidate, okay, and convert it into cash immediately. Your fixed assets are anything that's property, plant, or equipment, okay? And your other assets are anything that you can't physically touch. So intangibles such as copyrights, license, rent deposits, etc., etc. Okay? Any questions in regards to assets? Okay. So now we talk about liabilities. Liabilities is going to be everything that you owe. OWE. Okay? O, meaning, well, when we talk about accrual basis, what this can do is it's another way of owing people money, right? If you own a credit card, that's going to be considered something that's going to be considered a liability. Other things in that is going to be if you owe people service, like they paid you in advance, you owe them service. Or if you take a bank loan out or a business loan, you owe the bank money. So that's pretty much what this section is. Now, how do we categorize it? It's going to be based on how long you owe this person, vendor, or whoever you owe. It's going to be based on how long you owe them. So, for example, our current liabilities are typically going to be things that you owe within 30 days or 30, 60, 90 days. Okay. So, for example, if you have a credit on a specific a store, like a grocery store or a clothing store, they tend to want to keep your business. So what they do is they say, hey, if you open an account with us, then we can let you owe us money. However, at the end of a given time period, you need to pay us back. So that's typically going to be one of those things that, again, you have the option. You need to either pay within 14, 30, 60, or even 90 days. Okay? And usually that's going to be categorized as a current asset because it's going to be anything that you owe within a year. Okay? Anything that you owe beyond a year, so more than a year, it's going to be considered a long-term liability. Okay? Pretty straightforward looking at just the terminology. Current is, that doesn't really make any sense, but you have long term. Long term is pretty straightforward as far as understanding that it's more than a year. And usually your loans are going to be there as well. So that's pretty much it. Another thing that I want to also point out is never refer your liabilities as your debt, okay? There's a few little different terminologies when it comes to understanding accounting ways of doing this and then the difference between realty, property management. When you're in the realtor business, a lot of these terminology are similar, concepts are similar, but terminology is all over the place. So this is why I want to make sure that you guys understand that it is not something that you are creating debt for. It is an obligation that you are required to pay back. So that's That's what I want to get away here, okay? So again, liabilities is everything that you owe, okay? And they're categorized based on how long you owe them for, okay? Any questions for liabilities? Okay. Next section here is going to be equity. Now, your equity is going to be the total value of your company, all right? And because we are learning specifically this type of equity, right? When we go, so there's different types of equity when it comes to the different business organization that you establish yourself as. If you're a sole proprietor, you have what's called owner's equity, okay? If you're a partnership or you establish yourself as a partnership, you're going to have what's called partnerships equity. And then when you go into becoming a corporation, you're going to have stockholders equity. All right? So in this, of course, this class, we are only strictly learning owner's equity. And because we are primarily a sole proprietor, we're looking at a small business perspective. So what is entailed when it comes into equity is going to be things such as capital contributions. You know, your own money that you're reinvesting into your company is going to be considered your capital contributions. Your owner's equity, your owner's withdrawal are things that you're going to be pulling out of the company, right? If you can invest money in, you can also pull money out. Okay, so that's the difference between the different types of equity. Okay, if you go through corporate status, obviously you're not going to have a capital contribution. You're not going to have an owner's withdrawal. You're going to actually have stock holders equity, and you're going to have a section for your stocks, a section for your dividends, a section for your preferred stocks, things like that. Okay. So, but again, we're not talking about corporate. We're talking about sole proprietors. So your only main thing that you need to know are these two things, okay? And these two things, they're main accounts, and they affect equity. However, I want you guys to make note of this. Equity does not have categories, okay? So again, my assets have 3. Right? It has your current, your fixed, and your other assets. My liabilities has 2, current and long-term. Equity does not have any categories whatsoever. None. Okay? But these are the 2 key factors that are considered something that affect equity. Okay? And on top of that, besides the owner's withdrawal and the capital contribution, it is also affected by income, which we know as, okay, so this is the different terminology. Income, in this perspective, is going to be your revenues minus your expenses, okay, or also known as your profits. And then, okay, so again, equity has no categories. You cannot simplify or break it down even further, okay? So now we're going to move on to the last 2, which is your revenues and your expenses. So revenues, okay? It depends on what kind of core business your operations is. What is your core operations that allow you to generate income? Okay, so in this case, you can have operating income or operating revenues, whatever you want to use, okay? Typically, your operating revenues could be your sales. It could be your service sales, okay? It could be commissions, whatever you want to do, as long as you understand that what it is that you're trying to do that generates income to your company. So in this case, my primary focus on operating income is going to be my sales. And my sales of, in this case, if we go into Coffee Cafe, it's going to be my sales of coffee. Okay? Another category that belongs under that belongs under revenues is going to be either other income or also known as non-operating revenues. Okay, so you have a little or here, yeah, a word that you can use mixingly. So you have other income or also known as non-operating income. And usually these are generated based on things that are not the core business of your company. So for example, if I buy shares or I'm partnered up with another company, so if they send out dividends, I can use those dividends to be part of my company as a source of income. So if I were to do that, then that's going to be considered my other income because it is not my core business. My core business isn't buying stocks. It isn't to generate stocks to generate money off of stocks. My main core business is to sell coffee. So that's where every other income is going to be placed under. Okay. And then of course, lastly, we have our expenses. There are 3 categories that I want you to understand under expenses. First one's going to be cost of goods sold. So this one's going to be directly correlated to your inventory, okay? When you buy a product and you're trying to package it up and resell it, that's what a cost of goods sold is. It's basically how much did it cost you to sell this item, not how much did it cost you that you want to generate the extra profit for. That's a selling price. This is the costing price. So in this case, we're understanding that this is going to be an expense for the business, is that you're trying to get rid of the items. So we understand expenses as something is necessary that you need to spend or use up in the company. And in this case, if we have inventory, we're trying to get rid of it, so we're using it. Okay? And that's what cost of goods sold is, and we'll look into this actually when we dive into inventory, which is chapter 5. All right? So then besides selling your items or whatever inventory that you do sell, whether it's a good or service, the next category is going to be your operating expenses. So anything that it takes to run your business. So rent expense, right? If you need a facility or location, a store, you obviously need to pay rent in order to operate your business. Advertising expense. You need to spend the money to get your name out there, okay? License and permit expense. You may need to purchase that so you can even run your business, okay? So that's going to be something that's going to be correlated and directly related to your core operations of your business. Things to help you operate your business. And then we have the last category, which is non-operating expenses. So this is a very hard concept to understand, but it's very commonly used, and I want to make sure that you guys understand this. A non-operating expense will be anything that is not directly correlated to the core operations of your business. So for example, you have your location, right? Now you need to rent a warehouse to hold your inventory. Now, is your core business to hold inventory? No, it's to sell the inventory. But however, it is correlated to the core of your business, but it's not directly, it's more indirect, okay? So with this warehouse, you may have to pay for the land, of course. You need to rent out the location. You might, if for any reason, you may need to have some controlled temperature. So you might need to have a control there that you have to pay. So the utilities. You may even need to hire security because you don't want to put your assets out there and have it potentially be able for people to steal it. You want to secure it and protect it, especially if you're in a business where you're selling extremely valuable items, okay? So that's going to be considered a non-operating expense, okay? And then we'll also learn, well, actually, we won't learn it in this section, but if you go into managerial or cost accounting, you're going to learn that administrative expenses are separate. They're not directly correlated to your actual operations of a business. But in this case, it's giving you an example of a non-operating expense. Okay. Any questions about the revenues and expenses?
No, that all makes sense.
Okay. So this is what I was talking to you guys about. When it comes to understanding the nature of a business and how a transaction flows, is that this is going to be something very important. It's page 5 in your chapter 2 lecture notes. This is very important that you have, especially when you're understanding how to journalize a transaction. So this is called the normal balance. It's also known as the accounting model. And this is how you truly understand the flow of a transaction. So when we talk about understanding and categorizing and sorting our information, we're talking in terms of debits and credits. So again, debits are not positive, credits are not negative. Debits doesn't mean increase, credits doesn't mean increase. It's just a terminology that we use as placeholders, right? If you have cash, right, think about where that cash is going to go. Is it going to go into your bank account, or is it going to leave your bank account? So understand it like that in terms of debits and credits, okay? So use them as placeholders. So a good example I would say is if we are making an expense, okay? So an expense is something that we have to pay for. So if I need to pay for my rent expense, then normally in order to pay for a rent expense, you're going to increase your expenses because you're basically trading an asset for an expense. You're going to increase it on the debit side, but in order to do that, you need to decrease your bank account with a credit, and your bank account's going to be an asset. Okay? So when you pay for something, you're always going to decrease your bank account. If you gain money or you received money, you're always going to increase your bank account. So make sure you understand it like that. Again, terminology will come into factor and come into play, especially when we're understanding what the transaction is in the first place, how are we going to interpret it, and how are we going to organize it. So in this case, that is one example, okay? Same thing with sales. Same thing with a liability. If you owe somebody something, if you owe money to somebody and you're trying to pay them back, the notion is that if you're going to pay off a liability, you're not increasing a liability, you're decreasing it, right? You're minimizing what you owe. So in order to interpret that, you're going to debit the account, your liabilities account. And of course, if you're paying it off, you're getting rid of your assets, you're lowering your bank account, you need to understand that you need to credit your assets. So again, this will all make a lot more sense when we actually dive into chapter 3, which is actually taking that concept and actually placing it down in a journal. Okay. So this one, if you guys are new to this or are kind of rusty on this, I would suggest you to print out page 5 from your chapter 2 notes. But you know what? I'll actually provide the graph for you on the Google Classroom, and I'll let you guys know where to find it so you can print it out and save it. This is going to be very, very important and very, very useful, especially when we start learning how to journalize, okay? So this is the normal balance, okay? One way to kind of memorize this normal balance without really truly understanding the whole, understanding the flow of transactions is that normally your assets and your expenses, they're always going to have a debit balance, normally, okay? While your revenues, your liabilities, and your equity, they're normally going to have a credit balance. So what the terminology or what the definition of a normal balance is, it's usually the account that shows the side that is positive, okay? Meaning the side that increases is going to be considered the normal balance. So as you can see, the up arrows on your assets and your expenses are increased with a debit, while your liabilities, equity, and revenues are increased by a credit. Okay? Just a little tip for you there. Okay? Any questions in regards to this? This is going to make more sense as we continue going further down. Okay? So now, bookkeeping system. So this is very, very, very important that you understand this, because right now, as we're learning accounting, you're going to be understanding the double entry system. Now, the difference between them is how you organize your data, okay? So again, this is where the underlying your debits must equal your credits is come into play. When you're doing a single entry, right, you're only technically recording a transaction in one place. Meaning, for example, if I wrote a check out, okay, I know I decreased my bank account, but I don't record where the check actually went. That's going to be considered your single entry, okay? That you recorded, I wrote a check, my bank account is decreased. That's one-sided transaction, and that's going to be single entry. Your double entry is not only going to reflect how it happened, but why it happened. So this one's going to cover so if I wrote that same check, right, I'm paying for rent. So therefore, I'm going to be utilizing two accounts. One for my checking account. Obviously, I'm decreasing my money. And then I'm also going to place it in my rent expense, because not only did I pay for something, my equal and opposite transaction is going to be that I gained rent. Okay? So that's understanding the double entry, is that when you're placing in a journal entry or you're recording a transaction, you're recording them in two different places. Okay? And this is where I say this is kind of like applied science. If you have an action, you need an equal and opposite reaction. Okay, so that's where the debits must equal the credits. Okay, so obviously if you spend money, you need a place for where the money went. Okay, so that's just understanding this concept right here. Okay, and then here we are at our course review. So as we reviewed, we understand what accounting is, what the nature of a business is. We also understand that the accounting equation is your assets equal your liabilities plus your equity. That's very important. You also need to know that there are 5 account types: your assets, liabilities, equity, revenues, and expenses. You need to know that your debits is left and your credits are right. And also understand what the normal balance means. It's the positive balance in any specific account. So positive balance is going to be which side it increases on. Okay, so just know. And then here I have a little short little graphic depiction of your debits increasing your assets and your expenses, while I have the debits, the credits increasing my liabilities, equity, and revenues. All right. And then also, you need to know this one is going to be the categories of your specific account types. Understanding that your assets, liabilities, and equity are your permanent accounts, while your revenues and expenses are your temporary accounts. Few things here. Of course, your assets have 3 categories: your current, fixed, and other. Your liabilities have 2, which is your current and your long term. I am going to, make sure emphasize this again. Your equity has no categories. I even put it on the review sheet so you guys can recognize it. No categories, okay? And I will test you on this. And if you guys say there is a category, I'm just going to just facepalm myself, okay? Equity does not have categories. It's right here, says no categories. However, things that you do normally see that are under equity are your capital contributions and your owner's withdrawal. And then again, of course, for your revenues and your expenses, pretty straightforward. You have operating and non-operating, and then depending on what it is, income has other, while expenses has a cost of goods sold. Okay? Any questions in regards to chapter 2? No? Nothing for chapter 2? All right, let's quickly go ahead and go over the chapter 2 exercises, and then we'll call break. Okay? So question number 1 is, what are the 5 types of accounts?
Asset, liabilities, equity, revenue, and expense.
Yes, assets, liabilities, equity, revenues, and expenses. Yes. All right, number 2, what is a main account? What is a main account?
Umbrella account.
Yeah, it's sort of a primary account that's made up of all the sub accounts and contra accounts.
Good. It also divides the asset type. It gives more detail to the asset type, right? So asset type, gives more detail. The account types, my bad. Account types, and it okay. And then what is a contra account?
Opposite
Opposite of what?
of the main account.
Yes. No, good. Now, here's a little thing that I want to add on top of that. So a contra account, it gives more detail to either or the main account, or sub account. And with that being said, it flows in the opposite direction. Okay. Number 4, what does left mean?
Debit,
Yeah, this one's pretty straightforward. So debit. Okay, what does right mean?
credit,
Yeah, this is credit. Okay. What is the accounting equation?
Assets
Assets.
equal liabilities plus equity.
Good. Assets equals liabilities plus equity. Okay. Number 7. What are the 3 categories of assets?
Current assets, fixed assets, other assets.
Yes, fixed. So current, fixed, other. Okay. What are the 2 categories of liabilities?
Long term.
Okay, long term is one of them.
Current.
Yes, long. Okay. And then what are the categories of equity? What are the categories of equity?
Capital and
Capital
drawing.
contributions.
No,
categories.
no,
No
no.
No categories.
No categories.
No categories.
No categories. Ah, see, I knew it. No categories, okay? Make sure you remember this because I will quiz you on this and I will test you on this. There are absolutely no categories. Those 2 things are things that affect equity, okay? I need to put it in there because sometimes some people will be like, why didn't I see this before? So these are things that affect equity, but they're main accounts. Okay, they're examples of equity, but there is no categories. Okay. All right, what are the categories of expenses?
Would be the cost of goods sold.
Yes, cost of goods sold.
Operating. Non-operating.
Okay, good. And then you have operating and non-operating. Okay. And then lastly, no, okay, not lastly, what is the categories of revenues?
Sale of products and sale of service.
Okay, now there's actually
And other income, right?
other income is one, definitely.
And sales.
Sales.
Okay, sales, I'll give it to you guys for this one, but there's actually a more broader terminology for that. But I will give that to you. So it's going to be operating income or sales. Sales, I'll accept. Okay. And then number 12, what are the 2 accounting systems?
Single, double.
Okay, don't ever refer those like that, okay? It has to be single entry.
Single end.
Okay, single entry and double entry. Good, double entry. Good. Okay. All right, number 13. What is the normal balance? The definition.
The side that increases in the account.
Good. The side that increases in a specific account. Okay. Okay, so the next question is examples of accounts for the following exercises. Okay, so this one's where we're gonna practice this. Okay, so make sure here are the categories, here are the account types. So this is going to be an example that we're going to be looking at. This is going to also reflect things that we will see also when we talk about your test. Okay, so I will be asking questions just like this. I'm going to ask you. I need you to tell me what account type does it belong to, what category it belongs to, and what normal balance this account would typically have. So let's go ahead and take a look. So again, there are only account types, and there are a bunch of categories, and you guys should know what a normal balance is. So first things first, let's go ahead and look into here. The first thing I have is going to be a checking account. Now, what is it, a checking account? It's money in the bank. It is an asset. Yes, it is.
Yes, current asset.
And it's current. Good. Because it's already in its liquid form. And what kind of normal balance would it typically have?
Debit increase.
Yes, it is increased by a debit. Okay. All right, now the next question is going to be accounts payable. So it's money that you owe to other people or to vendors.
Liabilities.
Yes, it is a liability. So I'm going to do LAB. Actually, I can just spell it out. Liability. Now, what kind of liability would...
Current liability.
Correct, right? If you owe vendors, most likely they're not going to let you owe them for a year. Okay?
Credit.
And what would it... Okay, you said credit?
Yes.
Okay, so credit. Good. What about a copyright? What is a copyright? It is a legal... Hold on. It is a legal documentation, okay, of ownership of a... Ownership or right. Okay, so you said it was an asset? Yes, it is an asset. Now, what kind of asset is it?
Intangible asset.
What category is an intangible asset?
Other assets.
Other?
Correct. It is an other asset. All right. And what kind of normal balance would it typically have?
Debit.
It has normally a debit balance. Okay, good. All right, next one is going to be supplies. So supplies that are needed to operate the business. So this is kind of a trick question too.
Expense.
It's not an expense because we didn't
Current
use them
asset.
yet. It is a current asset, correct. Okay, so these are things that we are going to be acquiring to use in the company, yes. But the main thing here is once you buy your supplies, you own the supplies, don't you? Until you use them. All right, and that's the concept. When you use those supplies, typically it would have the word expense behind it. So in this case, it is a current asset because it's something that you can convert into cash easily, right? You can resell the pens back, or you can give it back to the store. Okay,
Debit.
and it is a debit balance. Good. Okay, what about loans? Okay, so anything that you owe the bank for. Okay, so
Liabilities.
yes, it is a liability. Okay, what kind of liability?
Income.
Long term, yes. And what kind of normal balance would it typically have?
Credit.
Credit, yes. Okay, good. Now the next one is going to be accounts receivable. So customers owe you the money. Not owning, my bad. Owing.
Asset.
Yes, it is an asset because it's cash that's supposed to be yours. So what?
Current asset.
Yes, because you're not gonna let your customers owe you over a year, are you?
Debit.
And it's a debit balance. Good. Okay. Next one's going to be an owner's withdrawal. So then again, this takes money away from your business.
promoter's equity.
Equity, yes, good. All right. Now, what categories does this belong?
No category.
No
Categories.
categories. Yes, no categories. All right. And what kind of balance would they normally have? So in this case, this is actually a trick question,
Credit.
not a credit. Now, that's a normal balance for an equity account. When you increase it, right, it's going to be a credit. But in this case, I'm taking away from my equity. So I'm actually
Debit.
decreasing my, yes. So this is going to be a debit. Okay. What about advertising expense?
It's gonna be
Okay.
asset.
It's not an asset.
Be an expense.
Yes, it's definitely going to be an expense. So again, this is buying marketing materials to promote your business. So it is going to be an expense. Now, what kind of expense is this going to be?
Current.
Okay, is there a category
Operating.
for
Would be an operating expense.
it be an operating expense? Good. So I'm gonna put oper. Okay. Now, what kind of balance would typically have for an expense?
Credit.
Not credit.
Debit.
It be increased by a debit. Yes. Okay. All right. Next is going to be cost of goods sold. What is cost of goods sold?
Cost of items.
The cost of the items that you sell. Yes.
Expense.
Revenue.
It is an expense. Good. Expense. Now, what category does cost of goods sold belong to?
Operating.
Okay, so remember, use your review sheets. What are the categories for expenses?
Cost of goods sold.
It is a cost of goods sold. So COGS for short. Okay. And what kind of balance would it normally have?
Credit.
Not credit.
Debit.
It's an expense. Yes.
Expense is a debit. That's right.
Yes. Good. All right. What about inventory? So it's items that you purchase and that you plan to sell. Say that again.
Asset.
Yes, it is something that you own. Yes. Now, what kind of asset would it be?
Asset.
Current.
It would be, yes, it would definitely be current because you can turn around and sell it right back for cash. Good.
Debit.
Yes, and it has normally a debit balance. So all assets and expenses normally have a debit balance. Okay. What about land?
Asset.
Yes, land is definitely an asset. Okay, now what kind of asset?
Fixed asset.
It is a fixed asset. Yes, it belongs in one of the three categories: property, plant, or equipment.
Debit.
So it's fixed. And it does have a debit balance because it's an asset. All right. Next is going to be sales. So earned money from a product or service when you sell, from selling it.
Revenue.
Yes, it's a revenue. Good. All right. Now, what kind of revenue is this?
It's sales or operating income. Sorry.
Mm-hmm. Sales are operating. Good. And it normally has what kind of balance?
Credit.
Good.
What sales is not a revenue, right?
It is a revenue. So make sure you look at that little normal balance sheet or the accounting model. It's going to show that it's normally increased by a credit. Okay. What about a capital contribution? Let me see how many. a capital contribution. So investing your own money into the business.
Equity.
Yes, it is definitely an equity account. All right. Now, what kind of category does this belong to?
No category.
No category. Good.
C.
All right. Lastly, what kind of balance would it normally have?
Credit.
Credit.
Credit. Yes, because this one's going to be increasing it because you're putting money in back into your company. So good. You're increasing the equity. All right. What about equipment? So any machinery or to run? Yes, it is an asset. Now, what kind of asset?
Fixed asset.
It is definitely a fixed asset. And
Debit.
yes, all assets are normally debited unless you use it, spend it, or etc. Okay? So, notes payable, IOUs to other people.
Liability.
Liability.
Yes, it is definitely a liability. Okay. Now, where would you say this is a current
Current
or a
liability.
long term?
Current liability.
Okay, so Nilo says current.
Yeah, it should be current.
Current. All right, so this one, it can actually be current or long term. So what a notes payable is basically, yes, it's IOUs that are from other people or to other people, sorry. So when you have this kind of concept, the one thing that you could do with IOUs is you can always defer payments. So you're not mandated to pay a certain time period. You can always defer the payment. So this can actually be a current asset or a long-term liability. Sorry, did I say current? Current liability or a long-term liability. Okay, reason being is because maybe you can owe it 6 months and then all of a sudden things happen and you have to go back to that person and say, can you extend me for another 6 months? If you extend another 6 months, then it becomes more than a year. So this can be a current or long-term liability because of its flexibility. You can defer payments when you owe somebody this money. And typically this is more for like owing a credit card, right? You say you're going to pay it off in 1 year, but of course with credit cards, you are unlimited to how long you want to pay it off for. Okay. Next one is going to be rent expense. So paying for rent.
Expense.
Yes, it is. And what kind of expense?
Operating.
Mm-hmm. And is it going to be a debit or a credit?
Debit.
Debit.
Debit. Okay, sorry, I skipped this one. So liabilities would have a credit balance. Yes. Okay. All right, couple more left. So what about delivery income? Charges to customer to cover for delivery.
Revenue.
It is a revenue. Yes. Now, what kind of revenue would a delivery charge be considered?
Operating.
Operating.
Now, unless you are,
Service.
say that again?
Sale of service.
Okay, that is if you are a delivery truck company. Now, most of, again, we're looking at merchandising company. So this one's kind of like a little vague, but in this case, it is not our main core of our business. All right, we don't deliver for our core of operations. We're trying to sell a product. So this is actually a service that's going to be considered that we don't. It's not part of our business. It's actually going to be an other income or a non-operating income. So I'm going to put other. Okay, And if this is a revenue, what kind of balance should it have?
Credit.
Credit. Good. All right. Last but not least is going to be purchase expense.
Be an expense.
Yes, it'd be an expense. And then what kind of balance? I mean, what kind of category would it be in?
The operating expense.
Operating. Good. And then lastly, what kind of balance would it normally have?
Should be a debit.
It should be a debit. Good. All right, so good job, everybody. Now, this is just things that we will look into when we start journalizing our transactions. So I just want you guys to have practice for this. So make sure that if you do download this, like, use it as a practice purpose, because these things may be on the test. And we actually will get to look at all of these in our fictitious business. So towards the end of our class, we will get to utilize these accounts and categorize them and either have them as a debit or a credit. So good job with this. I will post the answers in a second along with the accounting model sheet. So we're gonna go ahead and call break now. But little note here that I want you guys to get away with this is that a good quick way to kind of memorize this is that for most assets, it's pretty much anything that you can see that is an item or pretty much anything that you pretty much own. So it could be pretty much majority of these accounts are going to be typically assets. All right. Anything that you owe is going to have the word payable behind it. So that's a good key factor there. And also anything that's an expense would typically have the word expense behind it. So that's just a little fun fact if you needed some kind of study tactic for that. So that's like an easy way to be able to recognize each account. All right. So I'm going to call break. It is exactly 9:50. So let's do 20-minute break. So be back no later than 10:10.